A groundskeeper is mowing a hill of headstones on a Thursday morning. Somewhere in a filing cabinet in that cemetery's office is a receipt for one of the graves he's mowing around. A family paid for that plot in 1971, in cash, and never paid the cemetery another dollar. That transaction is finished. Closed. The relationship ended more than 50 years ago. And yet the grass on that grave grew this week, it will grow next week, and the cemetery is legally obligated to keep cutting it forever. That is the entire business in one image, and it explains why the assumption almost everyone makes about cemeteries is exactly backwards. The assumption is that this is one of the safest businesses on earth. Demand is guaranteed by biology, the product is scarce, nobody ever asks for a refund, and the land only becomes more valuable. All of that sounds correct. Some of it is even true. But the largest publicly traded cemetery partnership in America spent years distributing cash to investors and eventually got bought out for $3.50 a share. Cemeteries across the country have been abandoned to state programs and court-appointed receivers. And the reason is not that people stop dying. It's that a cemetery is not a real estate business. It's closer to a pension fund, one that collects money once and then owes payments forever. And once you understand what it's actually promising, you understand why so many of them quietly fail. Start with the version that looks irresistible, because it genuinely does. You buy 40 acres. Depending on layout and how much land goes to roads, buildings, and landscaping, a developed cemetery can hold roughly 1,000 graves per acre. That's a planning figure used in the industry, not a fixed law of geometry. So call it 40,000 grave spaces. At a few $1,000s per interment right, that's $100 million of theoretical inventory sitting on land you bought once. You don't need a factory. Your product requires no manufacturing. Your customers are generated automatically by mortality, and the National Funeral Directors Association reported the median cost of a funeral with viewing and burial at $8,300 in 2023, rising to $9,995 with a vault. So there's real money moving through this transaction. On a spreadsheet, a cemetery looks like a mine that never floods, staffed by 3 people and a mower. The problem is contained in that mining metaphor, and it's worth taking seriously. A mine has a defined quantity of ore. When the ore is gone, the mine closes, the equipment is sold, and the company walks away. A cemetery has a defined quantity of graves, but when they're gone, it cannot close, cannot be sold for redevelopment, and cannot walk away. It has to keep operating, at cost, with no product left to sell. That is the difference between a wasting asset and a wasting asset attached to a permanent obligation. And every single plot you sell brings that day closer. Read that again, because it's the sentence the whole business turns on. In this industry, revenue consumes the asset that generates the ability to pay future costs. You are not building a customer base. You are spending your only inventory. Which raises the obvious question a viewer should be asking by now: if maintenance goes on forever, who pays for it? The answer is a legal structure most people have never heard of, and it's the single most important thing in the industry. It's called a perpetual care fund, or an endowment care fund depending on the state. Most states require that when a cemetery sells an interment right, it must deposit a portion of that sale into a regulated trust. The historical benchmark you'll see referenced in tax rulings and statutes is around 10% of the sale price, though states vary enormously. Some set a percentage of gross sales, others a dollar amount per square foot. The critical detail is what happens next. The principal of that trust can generally never be spent, ever, by anyone. It is locked. The cemetery may only use the income the trust generates, the interest and dividends, to care for the grounds. So trace what that means for one grave. A family pays $4,000. Roughly $400 goes into the trust, permanently. The cemetery keeps the rest, and pays its bills with it. Forever after, the ground's care for that grave must be funded out of the investment income on $400. At a conservative long-run distribution rate, that's maybe $15 or $20 a year, in perpetuity, to cover mowing, trimming, roads, fences, water, insurance, staff, snow removal, and eventually the repair of a settling grave and a leaning headstone. New York's own consumer guidance is unusually candid about this. It notes that despite the word perpetual, the cemetery must provide the promised care only when the income on the trust is actually large enough to cover the cost of caring for the space. The obligation is real, but its funding is capped by arithmetic nobody re-examined after the sale. And here's the structural flaw that makes this worse over time, rather than better. The deposit is set by a formula written by regulators. Consultants in the funeral and cemetery space have been blunt that these formulas were political compromises rather than actuarial calculations, that they have, as one industry advisory firm put it, no real basis in what maintenance actually requires. Meanwhile, the cost side of the equation is almost entirely labor, and labor costs rise decade after decade. So you have a liability that inflates with wages and a funding source fixed at a percentage of a sale price from whenever the plot happened to sell. A grave sold in 1971 deposited $1,971 against grass that has to be cut with 2026 labor. Multiply that across an entire cemetery filled over 70 years and you get a gap that no single manager created and no single manager can close. So if the plot sale barely funds the plot's own upkeep, where does a cemetery actually make money? Almost everywhere except the land. The interment right, the piece of ground, is the entry ticket, and often the least profitable item in the transaction. The margin lives in everything attached to it. There's the opening and closing fee, the charge for the physical labor of excavating and filling the grave, which is a service rendered on the day, priced accordingly. There's the outer burial container or vault, a substantial line item on its own, with a median well over $1,000. There's the memorial, the headstone or marker, plus its setting fee and its foundation. There's mausoleum and columbarium space, which can be built vertically and priced at a premium. There are recurring flower placement programs. There is income from the trust funds. And crucially, there's the funeral home. The most durable operators in this industry own a funeral home and a cemetery in the same market, so a single family generates the service revenue, the merchandise revenue, and the property revenue at once. The land is the reason the family shows up. It isn't the reason the business survives. There's one more revenue mechanism, and it should feel familiar if you've looked at other industries built on prepayment. It's called pre-need, selling graves, merchandise, and services to people who are still very much alive. A customer pays today, sometimes over installments, for something that will be delivered at an unknown date decades in the future. From the family's side, it's prudent planning at a locked-in price. From the company's side, it is the arrival of cash long before the arrival of the obligation, and it operates on a scale that surprises people. Service Corporation International, the largest death care company in North America, operating roughly 1,900 funeral locations and several hundred cemeteries, reported a total pre-need deferred revenue backlog of about $17.6 billion at fair value as of mid-2026. That is not revenue. That is the accumulated size of the promises, work sold, paid for, and not yet performed. And that creates an accounting situation that has misled a remarkable number of investors. Under the rules, much of a pre-need sale can't be recognized as revenue until the merchandise is delivered, the service is performed, or in the case of cemetery property, until the property has actually been constructed and is available for interment. So a company running a spectacular pre-need sales campaign can be flooded with cash while reporting modest revenue, because the earnings are being deferred for years. That's conservative and appropriate. It also means the same set of facts supports two completely different stories. Management can honestly describe explosive sales growth. The income statement can honestly show something unremarkable. And an investor who is handed the first story while the second is technically also true has no idea whether the cash arriving this quarter represents profit or an obligation. Hold that thought, because it is precisely the fault line the biggest failure in this industry cracked along. Before we get there, though, the most counterintuitive fact in this entire subject deserves its own moment, because it inverts the way people instinctively judge a business. In most industries, selling all your inventory is triumph. In this one, it's the terminal event. A cemetery that has sold its last plot has, on that day, achieved something remarkable. Its revenue drops to almost nothing, permanently, while its maintenance costs reach their maximum and stay there permanently. Every acre now requires care. Every headstone now requires attention. Every road now requires resurfacing. And there is nothing left to sell but the small residual trickle of interments in graves already sold, and the interest on a trust that was never actuarially sized for the job. Full is not the goal. Full is the cliff. Which means every cemetery in America is running a slow race between how long its sellable inventory lasts and how well its trust has been funded, and the owner who is holding the property when the inventory runs out inherits all of the obligation with none of the income. Now add the shock that turned this slow structural problem into an active crisis across the entire industry: cremation. And the crucial thing to understand is that cremation is not simply a cheaper version of burial. It is the simultaneous removal of nearly every high-margin item in the transaction. No plot, in many cases. No vault. Often no traditional memorial with its foundation and setting fee. No opening and closing of a grave. The NFDA put the median cost of a funeral with cremation at $6,280 against $8,300 for viewing and burial, but the revenue drop for the cemetery specifically is far more severe than that comparison suggests, because so much of what disappears was cemetery revenue rather than funeral home revenue. And this is not a marginal trend. According to NFDA's reporting, the U.S. cremation rate reached about 63.4% in 2025, with burial down to roughly 31.6%. Their projection for 2045 is a cremation rate above 82%, with burial down near 13%. They also project that by 2035, every state and the District of Columbia will have crossed a 50% cremation rate. Think about what that means for a business model whose entire inventory is measured in square feet of ground. The demand for death care isn't shrinking at all, it's demographically expanding. What's collapsing is the demand for the specific product that cemeteries were built to sell. Now assemble the chain reaction, because every component is already on the table. First link, the cremation share rises, steadily, decade after decade. Second link, plot sales slow, and the vault, memorial, and interment fees attached to them slow with them, not gradually across the whole industry, but sharply in the markets that shift fastest. Third link, pre-need property sales slow too, which matters more than it appears, because that inflow of prepaid cash had been quietly funding present-day operations, including grounds care. Remember, the trust income was never sufficient on its own. The gap was being covered by the cash from new sales. Fourth link, with the subsidy shrinking, the operator faces a choice between eroding margins and reducing maintenance. Under financial pressure, maintenance loses, because it's the only cost with no immediate customer complaint attached. Fifth link, the grounds visibly decline. Grass grows long, a fence sags, a section floods. Sixth link, and this is where it becomes self-reinforcing, nobody chooses to bury their mother in a neglected cemetery. So sales fall further, which cuts the subsidy further, which degrades the grounds further. The obligation, meanwhile, hasn't moved an inch. It is contractual, permanent, and completely indifferent to the cash flow situation. This is not a demand problem. It's a duration problem, an asset that expires funding a liability that doesn't. The clearest documented example of what happens when you monetize this structure aggressively is Stonemore. It's worth walking through chronologically, because the mechanism is unusually well described, including in a federal court decision. Stonemore was a large owner and operator of cemeteries and funeral homes, hundreds of properties across dozens of states, and it was structured as a master limited partnership. That structure matters enormously. An MLP is built to pass cash through to investors as regular distributions, and investors buy it precisely for those distributions. Stonemore raised its distribution every year from 2005 onward. To investors, it looked like the ideal recession-proof income vehicle: death, taxes, and a quarterly check. But consider the collision between an MLP's need for present-day cash and the accounting reality we just walked through. Pre-need sales generate cash that is largely deferred as revenue and, in significant part, restricted in trust until the obligation is fulfilled. A company in that position, promising rising distributions, has a structural cash timing problem. According to the description in the securities litigation that followed, the Fan v. Stonemore decision, the company addressed that gap in three connected ways. It presented non-GAAP figures to investors that treated pre-need sales as a portion of current revenue. It borrowed cash in order to distribute the proceeds of pre-need sales in the same quarter the sale was made, rather than waiting for the money to be released from trust. And it used proceeds from issuing new equity to pay down that borrowed cash while the pre-need money remained in trust. Read the shape of that carefully, because it forms a loop: distributions funded by borrowing, borrowing repaid by selling new units, and new units sold to investors who were attracted by growing pre-need sales and the very distributions being funded by the borrowing. It is entirely dependent on the loop continuing. It requires perpetually growing pre-need sales and a perpetually receptive equity market. Nothing in it is sustainable on its own. The loop broke on September 2, 2016, when Stonemore announced it would restate roughly 3 years of previously reported financial statements. Weeks later came the part investors felt. The partnership declared a 50% reduction in its quarterly distribution to 33 cents, after more than a decade of increases. The units collapsed 45% in a single day. The income vehicle had just demonstrated that its income was, in large part, a timing arrangement. What followed took 6 years and was mostly unglamorous. The partnership converted to a corporation, cycled through management, sold assets, and attempted to rebuild around actual operating performance rather than distribution growth. The end came in 2022. Axar Capital Management, which already owned roughly 75% of the shares, agreed to acquire the rest at $3.50 per share in cash, and the merger closed on November 3, 2022. The company later resurfaced under a new name, Everstory Partners. The properties survived. The graves were still there, still being mowed. The public equity story simply ended, quietly, at a price that no longer resembled anything from the distribution era. And Stonemore is the version with a buyer and a balance sheet. The uglier version is what happens at the true end of the cycle, when the land is gone, the trust is inadequate, and the obligation still exists. Two things tend to happen. The first is that the property is simply abandoned, which is why numerous states maintain programs, receivership mechanisms, or dedicated funds for abandoned and derelict cemeteries, essentially the public absorbing a private promise that outlived its funding. The second is worse, and it reveals the incentive with uncomfortable clarity. When a cemetery has no inventory left to sell but still needs revenue, the only remaining inventory is ground that has already been sold. In 2009, prosecutors in Illinois charged employees at Burr Oak Cemetery near Chicago in connection with disinterring human remains and reselling the plots. That is a criminal case, not an economic model, and the overwhelming majority of operators would never contemplate it. But it demonstrates the pressure that exists at the end of the sales cycle, and it explains why this industry is regulated at the state level with trust requirements and inspection regimes rather than left to ordinary commercial law. The industry has adapted, and the adaptations tell you exactly where the economics were broken. operators began aggressively building cremation-specific inventory, columbarium niches, cremation gardens, ossuaries, scattering areas with memorial walls, products that convert a cremation from a lost sale into a smaller but real property sale. They push density because a niche wall occupies a fraction of the land a casketed grave requires and can be built upward, effectively creating new inventory without buying new acreage. They leaned harder into memorialization and personalization, since the emotional value of a permanent marker survives the shift away from burial. Companies like SCI now talk openly about cemetery inventory development as a growth driver, which is a revealing phrase, because it means manufacturing sellable product out of land they already own rather than waiting for demand to come to them. And consolidation accelerated, because scale spreads administrative and trust management costs across many properties, and because a well-capitalized buyer can absorb a cemetery whose inventory is nearly exhausted if it comes bundled with a profitable funeral home. So what does an honest range of outcomes look like for someone who actually owns one? The best case is genuinely excellent, and it's quieter than people expect. You own a cemetery with decades of remaining sellable inventory in a growing area. You own a funeral home in the same market, so each family generates the full economics. Your endowment trust has been funded above the statutory minimum by prior owners, and you develop high-density cremation and mausoleum inventory to extend the sales cycle. That business produces stable, inflation-resistant cash flow with essentially no competition, and it is exactly why institutional capital keeps buying them. The realistic successful outcome is a family-held or regional operator earning modest but dependable margins, with land in reserve, run by someone who treats maintenance as a balance sheet item rather than an expense. The realistic negative outcome is an older cemetery in a slow market with 15 or 20 years of inventory remaining, a trust funded at whatever the state required in 1968, and a deferred maintenance backlog that grows a little every year while nobody says anything about it. And the failure case is the one no financial model captures. The sales run out, the trust income can't cover the mowing, and the property is handed to a court, a municipality, or the volunteers who show up on weekends with their own equipment. Which brings us back to that groundskeeper on the hill, and the receipt from 1971. The reason cemeteries fail is not lack of demand, and it isn't bad management, though bad management accelerates it. It's that the business was built around a mismatch that almost nobody prices correctly at the moment of sale. The family bought something permanent. The cemetery received something one time. And the small slice of that payment locked away to bridge the difference was sized by a formula that was never designed to actually do the job. Every plot sold is simultaneously income today and a bill that arrives every week for the rest of time. So here's what this business is really about underneath the granite and the mowed grass. A cemetery isn't selling land, and it isn't selling a funeral. It's selling permanence, the assurance that a specific square of ground will be cared for and remembered long after everyone who paid for it is gone. That promise is the most valuable thing it has, and it's the one thing its balance sheet was never built to guarantee. The mine can close when the ore runs out. The cemetery has to stay open forever, on the interest.